A lot of times tenants look at letters of credit as effectively giving a cash security deposit to the bank instead of the landlord, and then paying a 1% to 2% fee on top of that. Assuming the tenant has better use of that cash than just keeping it idle at the bank, using an unsecured solution makes more sense.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, it's been crazy, man.
Real estate is always evolving, and it always gets so complicated and it's difficult. Like, I know now there's a situation where we're working on where it's hard to get a tenant and the landlord comfortable with what the tenant needs in terms of build out.
Yeah, there's no doubt. And, if it's not Starbucks and it's not CVS, many times some of these, I don't want to say it sounds as a pejorative, right? That they're smaller. They just don't have the credit rating on Standard & Poor's. That doesn't mean they're a bad tenant, but a landlord can feel insecure when you have a firm that's coming and asking, whether it be a doctor or a lawyer or whoever, is asking for a big build out and wondering whether they really want to take the risk. And this is a way to be able to, we're going to talk about this because this is something I thought was prudent because we're working on a deal just like that now. I thought it was prudent maybe to talk about some of the solutions that you might have to be able to fortify that tenant and help your landlord feel a little bit more secure about what's going on, and also the tenant to be able to expand.
And improve the quality of the tenant, improves the quality of the investment.
Yeah, no doubt. Guys, we live off of reviews. The reason we ask you every single episode is we're not being selfish about it. What happens, it's very challenging for us to be able to get good speakers to come on the show. There's usually about 5 people we ask. We'll be able to find one that comes on. There's a lot of work and time and effort that goes on into getting this show for you guys. We hope we're providing a value for you. What happens as part of the vetting process for potential guests is they go and look to see how current the reviews are, who's given the reviews, and what type of people that are listening. And we got an email here recently from Patrick Berman, who is the managing director of capital markets at Cushman Wakefield locally, one of the top brokers in the area. Patrick's always been very vocal in groups talking about what a good job we do. But he sent you an email the other day, and he said, Steven, I hope that all is well. I was listening to episode 196, James Schmidt, this morning. You and Eric are doing a great job. I recommend the Invest Florida podcast to friends and colleagues, not mutually exclusive. I mean, I think when you have somebody in the market that's a peer, and particularly someone of Patrick's stature,
Patrick, thank you. We really appreciate that. But I have another favor to ask for you. I really appreciate the email. Please put something on a review somewhere so that other people see it, and it just helps all of us.
It is meaningful for us in getting guests. And Patrick, we do appreciate the time that you took to write an email, and we don't, believe me, it does not go unappreciated. We certainly appreciate all of our listeners communicating, and they're all the same in our eyes, Stephen. But of course, Patrick is a guy that is also a peer, so it feels good.
Yeah, I mean, listen, respect or criticism from your peers is always taken more seriously. So thanks, Patrick.
Guys, we've got a great show for you today, so sit back and listen. I think we might be opening some eyes for you, particularly if you're dealing more in the retail, office, and industrial classes of investment.
Today we have with us Eamon Anderson. Eamon is Director of Strategy and Underwriting for the security team of the Guarantors Agency. Eamon graduated from Hamilton College in Clinton, New York, After college, he worked at Morgan Stanley Private Bank's tailored lending for 5 years, providing customized credit facilities to the bank's high net worth and private equity clients. His experience with a wide array of lending products and client types at Morgan Stanley gave him the experience to creatively underwrite and structure surety bonds for the guarantors' commercial clients. Eamon, welcome to the Invest Florida show.
Thanks a lot, guys. Really happy to be on.
Eamon, really appreciate you taking the time and talking with us today. You know, I met you. No, Sterling actually I think he called me independently several months ago and sent some literature over. And, you know, we're property managers as well as brokers. And we have this issue frequently with tenants who we can't get deals done with because there's large tenant improvement requirements. Restaurants, I mean, there's a number of things that could be have a need for that. Could be industrial buildings or office buildings. The landlord either doesn't have the capacity, maybe they're maxed out on a bank with their bank, or they're a little insecure about loaning to maybe not a national tenant. And this is what Sterling talked to me about, that you have a solution for that. Is that kind of fair for framing of what you guys provide, the solution you provide?
Yeah, definitely. I think that's a pretty good way to frame it. So I'd say said differently, what we offer is an insurance version of the commercial security deposit. So from a landlord's perspective, it's as good, if not better, than the incumbent solutions to cover the risk of missed rent or high upfront TI costs. But from a tenant's perspective, it's a lot cheaper because it's totally unsecured. So all they have to do is pay an annual insurance premium that's going to be anywhere from, call it 2 to 9% of the security deposit amount per year. Average is probably about 5%. And then they never have to put up the full amount of the deposit in cash. So as an example, if say landlord has a very expensive build out and, would need $1 million of protection to protect against their upfront investment, we could put something in place for, call it, $40,000 to $60,000 a year. And then the tenant would save that $950,000 that they're not giving to the landlord, and they can reinvest in the business. And then from the landlord's perspective, they're getting a surety bond that works just like a letter of credit. And it's, backed by investment grade credit, payable on demand. And from any of the landlord's lender's perspective, it works just like a letter of credit.
Yeah, like a letter of credit. Let's talk about, because I originated from a banking background. My first job out of school was as a commercial loan officer, sat in the credit pool first and did a number of letters of credit. And in the old days, when I was getting started, we would provide letters of credit on the faith of the borrower, the credit rating, and we would provide a letter of credit. And there was very little guarantee because the bank would say, you know what, this is a person that we have full faith in. We'll go ahead and give them a letter of credit. There was a fee that would be attached to that. And that would be it. It would be a fairly inexpensive process. That has changed significantly. What you see now is, in many instances, the bank having to take 100% of, let's say, in a CD or some sort of asset that's posted to be able to hold as collateral for that letter of credit. And so now you start to see, if you're running an operation and you have $1 million of tenant improvement, to have to take $1 million and give it to the bank and pay a fee to give to the letter of credit and produce a letter of credit to give to the landlord, all of a sudden it's painful. Like, the funds are out of your system regardless, right? Like, now no longer do you have access to those funds. At some point, maybe you're going to get released to the letter of credit after you prove your performance, but it's a massive cash outlay. And what you guys are doing is getting around that. Is that proper? Am I talking about that properly, Eamon?
Yeah, no, I think you hit the nail on the head. So, a lot of times tenants look at letters of credit as effectively giving a cash security deposit to the bank instead of the landlord, and then paying a 1 to 2% fee on top of that. So, assuming the tenant has better use of that cash than just keeping it idle at the bank, using an unsecured solution makes more sense. Typically, letters of credit are cash secured. Another variation would be a tenant has a larger revolving line of credit and they issue the letters of credit as sublimits of that revolver. And then those revolvers typically are secured by some less liquid type of collateral, so usually accounts receivable. The issue there, though, is that if you're issuing letters of credit out of that revolver, that then ties up your borrowing capacity, and it's the same issue as tying up the cash. You can't use it anywhere else, and it just is parked idle.
So, Eamon, you had mentioned, and I understand how that works in terms of initial build out and it really helps the tenant and it helps the landlord. It offers a solution. But what intrigued me was the part where you mentioned where it protects them for the term of the lease in terms of not missing rent payments. How does that work?
Yeah, definitely. So the way our bond works is landlords can make a claim and get paid under the bond if an event of default occurs on the lease. So typically, events of default are defined in a lease as missed rent, property damage, and a couple other triggers. So whatever would trigger usage on a cash security deposit or a bank letter of credit, that's what would trigger usage on our bond. So, when landlords are doing their accounting when they're drafting up leases, what they ask for security deposits is going to be a function of A, their upfront investment in tenant improvements, and then B, the risk of that tenant missing rent in the future. And a combination of the two is the number that landlords ask for a security deposit. So we cover all the above. So, missed rent or property damage.
So let me ask you just a hypothetical question. Just a typical small lease. It's a tenant and he's going to go into a building and it's going to cost, his rent's going to be $10,000 a month. It's a new tenant. The landlord doesn't know him and he's got to pay, the landlord's going to ask for first month, secure and upfront and last month security standard, and how would the fees work for that? And he'll also require $100,000 build out.
Yeah, and let's talk about the size of the deal that these work on.
So how would it work with this scenario that I explained? $100,000 build out, $10,000 a month rent. What would be expected of the tenant?
Yeah, definitely. So, say it's $10,000 a month. So say all in, the landlord would be asking for $120,000 of protection. So 2 months of rent plus the $100,000 build out. So, as I said, our average price is about 5%. So we could put something in place that would cover the landlord for the full $120,000 for, call it, $6,000 a year. So think of that as 5%. So the way we always try to frame it for tenants is that the rate we charge is akin to the interest rate they'd get on an unsecured loan. So this would be them borrowing at 5%. Obviously, this is insurance. It's not actually a loan, but it's very closely equivalent. In terms of the sizes, I'd say we don't have any hard or soft floor for both the upper or lower bound of what we can do. I'd say practically the smallest we could do would be $10,000 to $20,000 on the low end. And then on the high end, I'd say roughly $5 million. But again, we evaluate these on a case by case basis. And if you were to send me a deal that's $6 million or $9,000, I'd be happy to take a look and see if there's something we could provide.
So just going back to the example that you said to us, you said it's $10,000 a month, $120,000 per year, and then there's a build out of $100,000. But actually, assuming it's a 5-year lease, then you'd want to insure $600,000 plus the $100,000 build out. Is that correct? $700,000.
So the way I was thinking of it would be more, if the landlord's putting it's a $10,000 a month lease and the landlord's putting in, $100,000 of their own money to build out the space, that basically means that, the landlord has $100,000 to protect against that obviously that amount will burn down as the tenant pays rent and the landlord gets closer to breaking even. But just say, from the onset, the landlord needs $120,000. It would be just $6,000 a year to give the landlord $120,000 of protection at any given time.
No, I mean, and let's talk about a little bit from the landlord perspective, because when I've been involved in these types of deals from the real estate side, there's this dance of death with the landlord and the tenant. If they're going through the old school established methods of getting a letter of credit, that they're determining how long that the tenant is going to have to retain that letter of credit. So there's this discussion of payback period and whatnot, because they're tying up a massive amount of cash for the tenant's perspective, and they want to get that cash back so they can deploy it. The landlord's trying to keep it as long as possible. It sounds like, but we're still having the same type of discussion, except for that there's a sinking aspect to your piece of it. Is that fair to say?
Yeah, I think that's a very fair way to look at it. I'd say another way to look at it is is an easier way to bridge the gap between what the landlord wants to feel protected and what the tenant is willing to pay. So, obviously, if the only way to get from point A to point B is just tying up 100% of what's being asked for in cash, there's going to be a pretty big gulf between what the tenant's willing to provide and what the landlord needs to feel protected. Whereas with this, just because, again, pricing is single-digit % of what the landlord's asking for, it's a lot easier for both parties to arrive at a solution.
And so how is this typically addressed? Is it written into the lease that the tenant shall take out this insurance, just the same like the other obligations of a tenant?
So typically the way it's drafted in the lease is, there will be a section either for security deposit or separately for letter of credit. And it's as simple as really just, finding and replacing letter of credit with surety bond. And then typically with letters of credit, there's language about the issuer rating. So, the issuer needs to have a Moody's or S&P rating above BBB. So the equivalent of that for insurance would be the AM Best rating. So typically, the floor that landlords put into their leases would be an AM Best rating of A-. So it's just swapping out two moving parts with surety bond and AM Best rating, and beyond that, it's business as usual.
Let's talk about the tenant in terms of what is the ideal. I suppose, well, like what does the balance sheet need to look like? What kind of credit history they need to be established? I'm assuming this is not really a good startup type of a deal unless it's like a well-funded startup. So can you talk a little bit about what the credit analysis looks like on the tenant side?
Yeah, definitely. So, we want to see everyone that's interested. So I would just take everything I'm saying with a grain of salt. If it sounds like there could be a fit, I'd be happy to talk through it with you guys. But I'd say just generally, the balance sheet, we want there to be equity on the balance sheet. We don't want them to be too over levered, and we want there to be some liquidity. So, we don't want them to be wholly dependent on, raising new equity or debt to keep operations afloat. Just in terms of the kind of businesses we want, startups obviously get a lot of value from a product like this because their cash is very dear. The startups are obviously riskier. So we don't, categorically deny new businesses, but what we would want to see is if it's a new business, that there's enough left in the tank, meaning, as you said, a well-funded startup where even though they are burning money to grow, they still have enough left that they're not going to run out of money anytime soon or, in the first year or so of the lease. So that's definitely a tenant we can work with. And then the other thing is something that we look at is for startups, if there's somebody that would be willing to personally sign on with the bond, say that the tenant doesn't check the box where, they just don't have a ton on their balance sheet, but there's a founder that would be willing to personally sign on to the bond. That's another way we can get it done too. And we see that all the time, especially for newer startups where, the financials of the founder and the company itself are very much intertwined. Got it.
When I've seen this and where I wished I'd known about this with some of my tenants in the past, what first comes to mind is that franchisee that has a fairly decent balance sheet that from an operating standpoint, But if they want to meet their build out goals in terms of new locations, they'll smoke their cash reserves, and then it's going to put their operating position in jeopardy if they do that. And so they typically will lean back on the landlord to do the tenant improvement work. Of course, if you're somebody like Starbucks, where you've got your national credit tenant, it's not as big of a deal because you can take that to the bank and find loans on it. But for the franchisee, there is not going to be as the funds and the credit is not going to be as flowing. So if that's one to me that comes to mind, that would be a good example. What are some others that you could just, one or two others you come to mind and say, these are other folks that we've been able to help?
Yeah, definitely. So hit the nail on the head with franchisees. They, probably more than anyone can benefit from a product like this because of the reasons you said. I'd say other tenants that really get a lot of value would be law firms, because typically with the partnership model, at the end of the year, they want to give whatever cash they have left over as bonuses to the partners. And using our product to cover the security deposit is just one more way to increase that bonus pool. And those are almost always, very strong tenants, very profitable, stable revenues. And so law firms are right down the fairway for us.
I was going to say, Stephen, I don't know any attorneys that care about money. Do you? Do you have clients tenant attorneys that care about money?
They don't even use the clock anymore. It's just
free.
Yeah, they're just so happy to give it.
It's just free.
I mean, every attorney is walking with his pockets full, and inside's a big clock, and they put it on the desk and they push it when you say hello.
No, but it is true. I mean, I didn't think about it from the attorney standpoint, but that's something that they have issues, and many times, particularly the personal injury guys, will have a pipeline of really massive deals coming in. And I would also see where they're kind of living off of a credit line until those deals get that pipeline gets solved, and this could be that solution for them. There's no way they're going to want to tap additionally into that credit that they're going to need for operating funds until that that 7-figure settlement comes along 9 months down the road. So I didn't think about law firms, but that makes sense.
Well, you can see it working for medical also, just a
medical, yeah, because the expense of the build out.
Yeah, I mean, you take a dentist, for instance. You can't build out
$200+ a square foot over improvements over the standard improvement just to build the cabinets and the sinks and all that, the plumbing and all that stuff. Yeah.
So Eamon, how does this go down when you actually meet with someone and explain it? I mean, do you find people understanding and taking to the concept? Oh yeah, no, this product. Not to take away credit from our sales folks, but it really does sell itself to the tenants, because it's very simple. It's basically, you have this problem where you have to put up a big sum of cash and it just sits idle. So instead of doing that, you can just have a cheaper solution, and the cash that you're not putting up, you can reinvest in the business. I mean, that's as simple as it is. So, I'd say tenants are very receptive. I'd say you mentioned like big credit tenants like Starbucks or Pfizer or Exxon or a company like that. They're typically not being asked to put up much in the way of security deposits anyway. So, they aren't always great. Sorry.
Try to cut a deal with Starbucks and they'll try to get a deposit from them. Good luck.
Yeah, no, exactly. So, the kind of tenants that aren't being asked to put up deposits, this isn't really a great fit with. But for the vast majority of tenants where they're not, Fortune 500 companies, and then they're not, brand new startups, this is a good fit, and we should be able to underwrite and approve them.
And so how do you frame it to them? Do you say to them, look at it this way, instead of paying $10,000 a month, you'll be paying $10,500 a month, and you've got the build out and everything that you need, and the landlord's happy?
Yeah, I mean, that's really it. Is I always try to take, because usually by the time we get approached, they have some number in their head that they're going to have to put up for the landlord. So I always give the example of $100,000. So, the landlord's asking for $100,000. That's a mix of, first and last month's rent plus the build out. They can either give the landlord $100,000. They could get a letter of credit, which is giving the bank $100,000 plus paying, call it an extra $2,000 on top of that as a servicing fee. Or they could work with us and pay, I'd say on average, $5,000 a year. And then that $95,000 that they're not spending on the deposit, they can just reinvest in the business, hire more people, upgrade their infrastructure. And then, from a landlord's perspective, this product, because the tenants aren't, digging under sofa cushions to come up with the deposit, it actually makes them a much stronger tenant, and it makes their ability to pay rent higher. It makes their attractiveness to their customers higher. So it really is a bit of a cliche, but a win-win.
Well, I can see an additional argument for that, because from the landlord's perspective, he's now got a much higher quality tenant, and it makes it much more valuable to an investor. I mean, it's
more secure, no question.
He'll be able to sell it at a lower cap rate.
Yeah.
Yeah. Oh, yeah, no, exactly. And then, the credit backing these bonds is as good, if not better, than any letter of credit issuing bank.
Well, Eamon, that was very interesting, and we learned a lot on this. I can see how it can benefit some tenants as we go along. And landlords. Yeah.
I mean, landlords. We're talking to the investor class here, and they're the ones that are concerned about these guys. They turn away guys that are a little bit nervous about this. Can solve their problems.
Sure, because it turns them into credit tenants.
Yeah, exactly.
Ah, that's awesome. So, Eamon, how can people reach you if they want to learn a little bit more or talk to you?
Yeah, definitely. So, if anyone has any what ifs, if they have a tenant that could use this, if they're working on an asset sale where the security deposit's getting in the way, whatever it could be, just send a quick email to info@security.io. And security spelled SECURITI.io. So security with an I.io.
Yeah, and we'll put Sterling's information also on, if that's okay, we'll put it on the show notes for this episode. And then you've got 2 points of contact there to reach out if you've got any questions or concerns about the offering.
Yeah, no, that's perfect.
Eamon, thanks so much for your time, my friend. Anything else before we let you go?
I think that's it. I think just obviously everyone stay safe, and we're all in this together.
Yeah, we definitely formed a bond.
Oh, please. I'm at least thankful he waited till the end to do that. Thanks so much, Eamon.
Thanks, Eamon.
Thanks, guys.
Bye.
And that was Eamon Anderson talking about some alternative ways to be able to really secure your tenants. And landlords struggling with this type of thing sometimes. And
it's a great tool for the landlord. Eric, for instance, was there a way that landlords could have protected themselves during this whole coronavirus episode where all our phones were ringing off the hooks with tenants trying to reduce their rent payments?
Yeah, those are not fun telephone calls to take. But if you've got somebody who maybe you have a little bit of a question about, and this is not for bad tenants, let's be sure about that. It's for folks that have a decent balance sheet. The issue is that maybe it's not a risk that the landlord's willing to take or can take. And so to be able to have this additional backing is peace of mind. And from the tenant standpoint, it's not taking valuable cash out of their reserves to be able to defend themselves. And when you have this type of a virus situation that popped up here.
Well, you may think actually that from a landlord's perspective, maybe it's worth reducing rent a little and inducing a tenant to take this insurance. It maybe higher credit. Yeah, protects both.
Yeah, exactly. You're basically substituting it as a higher credit than it really is. So yeah, it's a good stuff. Stephen, Eamon was a great guest, as all of the guests that we've had, and people want to go back and look at past episodes. How would they do that?
The place to go is www.investfloridashow.com. That's our website. Also, download the app on your mobile device and listen while you're mobile or in the gym.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.